Hello and welcome to the Global Forecast from the Economist Intelligence Unit. My name is Tony McMahon, and as ever I'm joined by Robin Bew. Now Robin, the possible return of mass unemployment, what policy challenges and economic problems is that likely to create?
Well, I think that's now something that we're looking at in quite a lot of countries because the pace of recovery and most economies now are growing again. Some of them are growing pretty quickly, but a lot of policy stimulus behind that. And as that wanes, our longer term view is that growth is going to be much more sluggish, at least in the rich world that we've been used to. And that suggests to us that largely this is going to be a jobless recovery. So as you say, for policymakers, that creates quite a difficult dilemma because we see in some countries where the labour market's a bit more flexible, such as in the UK or in the US, that you will see industrial change which supports perhaps gradually more job generation over the longer term as you see industries decline and new ones come up. But when you look to other markets where perhaps the labour market's a bit more rigid, such as Germany or France, you see this very stark insider-outsider situation which has been there for a long time, but it's likely to get even worse going forwards, where people who are in employment are pretty protected, but if you're outside of that protective cocoon, it's going to be extraordinarily difficult to break in, even for relatively low wage employment, unless you're prepared to take just temporary and contract work where don't really have any labour protection. So I think for policymakers, a very serious problem, back to some of the issues that we faced in the 80s.
With some signs of stability then in the global economy, you've revised upwards your growth forecasts for the US. Why is that?
Yeah, I mean, if you look at what's happening in the US, that the policy stimulus that we've had really is feeding through pretty strongly now. So the Q3 data was quite nice. I mean, growth quarter on quarter annualised was over 3%, so pretty strong. Obviously, cash for clunkers has been helping there, and you've had a lot of liquidity being injected into the economy more broadly. We don't expect that to be a story which is going to run in the long term. The policy stimulus will run out, and then gradually growth will drop back to something that's a little bit less exciting than we've seen. But that story, which is policy stimulus is feeding through, has been repeated in a lot of markets, and that's leading us to revise up at least the 2010 outlook. But when you look out to 2011, actually we're relatively downbeat about the prospects for growth. And the thing we're cautioning all our clients about is not to assume that the strength of data that we're seeing at the moment is indicative of how this recovery is going to play out in the longer term, because we just don't believe that.
I mean, you mentioned there a waning fiscal stimulus. So how do you think the Fed is going to balance that against rates policy?
Yeah, I mean, if you look at what's going on in the US right now, I mean, the fiscal stimulus is pretty strong right now, and interest rates are extremely low. As we get into next year, I mean, a lot of the announced policy measures on the fiscal side are going to be ebbing away. Now, we do think that you will see the government step back up and announce some additional spending, but it will necessarily be less than we had this year just because of affordability issues. The fiscal position in the US is very weak. But at the same time, the Fed is quite nervous about long-run inflation expectations. Clearly, the amount of issuance that we're seeing the US government doing is very significant indeed. They're aware that the longer they leave interest rates down where they are at the moment, the bigger the danger is that people will start to worry about perhaps the long-run inflation story is not quite as robust. Already you see plenty of people, including ourselves, talking about how inflation is an exit route for governments who are building up a lot of debt. And the Fed is going to be nervous about that perhaps becoming a bit too entrenched in the market. So I think second half of next year, you're going to start to see some policy tightening from the Fed. Not a lot, but we think by the end of 2010, interest rates will have risen to 1%. So it's not really having a retarding effect on the economy, but at least it gets some message into the market that they are aware of the issues. But in terms of taking interest rates back up to what anyone would consider to be normal, we're way away from that because the growth outlook is actually much poorer than perhaps this latest data suggests.
And if US rates do remain at currently low levels, more or less, where is that going to leave the dollar trending over the next year?
Well, the dollar's weak at the moment, and we think it's going to stay weak at least for the next 6 to 9 months or so, because what we see happening right now is that as the world improves, and I think particularly this is really an emerging market story, as you see Asia look stronger, bits of Latin America looking stronger, risk appetite is starting to return. I mean, yields are terribly low in America for sort of investment grade assets. And so investors now are thinking, well, the world looks a bit stronger, perhaps I should put some more money in Asia. So they're taking money out of the States, that's pushing the dollar down. That will probably continue right through, certainly into the middle of next year. And once the Fed starts to raise, I think you would see a little bit more strength coming back into the dollar at that point. And also then I think there will start to be a bit of a reset around growth expectations, because right now when I read a lot of newspaper commentary, people are starting to think, now the V is back when people are describing this recovery, because the quarter-on-quarter data is looking so strong. And I suspect that as we get into the second half of next year, people will start to talk about long-term unemployment and the issues that we were discussing earlier. And that's going to mean people become a lot more cautious again, and the dollar tends to get a bit stronger when people are cautious, because people want to hold US Treasury bills when they're worried. So you see people pull back into the dollar again. So dollar weakness for a bit, but then a bit of strength perhaps towards the end of next year.
So turning to Germany and France, has it really been a case of first in, first out with regards to their recession stories?
Well, I think there's a couple of things for them. I mean, the first thing is that this is a financially driven crisis, although clearly it's spread throughout the rest of the economy, and Germany and France had much smaller financial sectors relative to the size of their economy than we had in the UK or even than America did. And so as a result, if you look at Britain, which is perhaps in the extreme here, this crushing of a very large piece of the economy, that's not really happened in Germany and France. Banking sector's been hammered, of course, but the banking sector was much smaller. The other thing which is going on is the policy stimulus. Clearly the ECB hasn't cut rates by quite as much as we've seen the Bank of England or the Fed, but they've injected so much liquidity into the economy that effectively, if you look at market rates, the easing has been just as significant. And then on top of that, France and Germany have actually done a lot in terms of fiscal policy. And when you look to the UK, that's not really been true. So much money has been spent on bailing out the banks. There's not much left over for stimulating the economy more broadly, whereas in Germany and France, you've seen them try to do that quite aggressively. And those things are meaning that they're turning around more quickly than Britain. Britain, unfortunately, looks in a pretty bad place.
So is it a return then to the UK being the sick man of Europe?
Yeah, we're back to all that again, I'm afraid, yes. I mean, Britain does, clearly it's lagging behind, so it's had at least one additional quarter of recession in comparison to the other markets. Hopefully it's only one, but could turn out to be two. But I think the longer run story is also much worse, because the UK was so reliant on financial services, and the financial services industry, clearly when you look at some of the press reports right now, you see that profitability is rebounded and all of that kind of stuff. But the bigger story is that the banking sector is going to be much smaller and ultimately drive a lot less growth through the British economy than it did in the past. And whereas other countries around the world have other strengths to play with, for Britain we had a lot of eggs in that financial services basket, and for us it's going to be a much more difficult long-term haul. And so I think Britain is going to look pretty sick for quite a long time.
Thank you, Robin. So a gloomy outlook for the UK in the short term. To find out what's going to happen to the global economy in the future, tune in again next month to the Global Forecast. Until then, thank you and goodbye.